The photos still look perfect. Snow-dusted peaks, charming Victorian main streets, ski runs that disappear into endless blue skies. For generations, Colorado's mountain towns represented something profound in the American imagination. Places where hard work, natural beauty, and tight-knit community could coexist. But in 2025, that delicate balance has finally broken. The market shifts we're seeing aren't just about real estate prices. They represent the unwinding of entire community structures that took 50 years to build. Our research teams have spent the last 6 months analyzing market data, insurance trends, and economic indicators across Colorado's high country. What we've found isn't a story of villains and victims. It's a story of unintended consequences, where multiple economic forces collided to create outcomes nobody wanted. Today, we're examining the 5 mountain towns experiencing the most significant market corrections, not to celebrate their struggles, but to understand what happens when affordability, investment pressure, and climate reality converge. This isn't about schadenfreude. It's about understanding a market transformation that holds lessons for mountain communities nationwide. If you're invested in real estate, considering a mountain property, or simply care about the future of these iconic places, this analysis matters. Hit subscribe to Housing Intel for data-driven insights that go beyond the headlines. Number 5. Steamboat Springs. For decades, Steamboat Springs represented something rare, a genuine ski town that never lost its ranching roots. Friday night high school football, 4th of July rodeos, and a main street where locals actually shopped. But between 2019 and 2023, something fundamental shifted. The median home price doubled from $420,000 to $870,000. During that same period, according to local economic data, median household incomes rose just 8%. Our teams identified a troubling pattern. The Steamboat Springs School District enrollment dropped 10% last year. The local hospital declared a staffing crisis, unable to recruit nurses and technicians who can't find housing within an hour's commute. These aren't abstract statistics. They represent teachers, healthcare workers, and service professionals who built their lives here, only to watch their community become economically inaccessible. The real estate correction reflects this reality. Single-family home sales volume has fallen 40% compared to 2 years ago. The condo market tells an even starker story. Steamboat Springs has thousands of aging units from the 1980s and 90s, many with monthly HOA fees exceeding $1,200. Combined with Colorado's new short-term rental taxes, these properties have become increasingly difficult to sell. Condo inventory is up over 120% year-over-year, with prices down approximately 25% from peak. What makes this particularly challenging is the bifurcation. Multi-million-dollar ranch properties sit unsold, while the more affordable condo market races downward. The middle has been hollowed out because the middle class has been displaced. This isn't market correction, it's community transformation, and the human cost extends far beyond property values. Number 4. Breckenridge. Breckenridge welcomes over 3 million visitors annually. Its Victorian Main Street and world-class skiing have made it an icon of Colorado mountain culture. But our research reveals a town struggling with the consequences of its own popularity. The Breckenridge Town Council, facing an acute housing crisis, enacted some of the strictest short-term rental regulations in the nation. Properties that investors purchased specifically for vacation rental income suddenly faced severe restrictions. The market response was immediate. According to rental analytics data, revenue for short-term rental operators in restricted zones dropped 70%. This triggered panic selling from over-leveraged investors. Inventory surged 90% year over year. These aren't phantom listings. They're real properties with real owners facing real financial pressure. Currently, homes in Breckenridge sit on the market for an average of 180 days, 6 months. The median home price remains over $1.5 million, but actual transaction data tells a different story. Properties are selling for an average of 8% below already reduced asking prices. Our teams found local title companies reporting 6 consecutive quarters of declining transaction volume. The downtown commercial corridor reflects the residential struggle. The Breckenridge Business Alliance documented 45 vacant storefronts on and around Main Street, the highest vacancy rate in recorded town history. Tourism numbers remain strong, but visitor behavior has changed. Day trippers have replaced multi-week vacation renters. The economic model that supported property values has fundamentally shifted. For homeowners who purchased at peak prices, especially those who planned on rental income, the current market represents significant financial strain. But there's a deeper tension here. The regulations that crashed investor values were implemented to preserve community housing. The town chose long-term residents over short-term profit. Whether that trade-off ultimately succeeds remains uncertain, but the immediate pain is undeniable. Number 3. Telluride. Telluride occupies a stunning box canyon in southwestern Colorado, so isolated that wanting to be there is prerequisite for arrival. For ultra-high net worth individuals, that exclusivity was precisely the appeal. But in 2025, even billionaire buyers have limits. Our analysis shows the number of home sales exceeding $5 million has fallen 85%. The ultra-luxury market has effectively frozen. Properties now sit an average of 275 days before selling, approaching a full year. Inventory of homes priced between $5 and $10 million is up 150%. But price isn't the only issue. Telluride's box canyon location creates acute wildfire risk, and insurance markets have responded accordingly. Major carriers, including State Farm and Allstate, have issued moratoriums on new policies in high-risk Colorado zones. You cannot secure a mortgage on a home you cannot insure. For existing homeowners, annual insurance premiums have become crushing. Properties that once paid $8,000 annually now face quotes of $15,000 to $20,000 when coverage is available at all. This structural insurance crisis makes the market increasingly dysfunctional regardless of price. The town's cost of living has reached unsustainable levels. Our research teams documented basic groceries costing 40 to 60% above front-range prices. The workforce crisis is severe enough that businesses bus employees from towns 2 hours away. Census data shows Telluride's median age has increased 6 years in the last decade. It's becoming a town of aging, part-time residents. This isn't a story of luxury homeowners deserving hardship. It's a case study in what happens when a location becomes so expensive that the economic ecosystem supporting it collapses. Service workers, medical professionals, teachers, the infrastructure of normal community life becomes impossible to maintain. Property values ultimately reflect that reality. Number 2. Vail. Vail was designed to be perfect, a purpose-built alpine village that became synonymous with world-class skiing and luxury mountain living. For 50 years, Vail real estate was considered among the safest investments in America. That perception is now being tested. Transaction volume in Vail Village has plummeted 70% from peak levels. The buyers have simply disappeared. The core challenge is aging inventory. The average condominium in Vail Village was built in 1984. Many units require $200,000 to $500,000 in renovations to meet current buyer expectations. Combined with monthly HOA fees averaging $2,000, that's $24,000 annually before mortgage, taxes, or club memberships. For a $5 million purchase, you're looking at potential total costs exceeding $750,000 in the first year between down payment, renovations, and carrying costs. Younger wealthy buyers are comparing Vail to newer resort developments in Jackson Hole, Big Sky, and Utah. They're choosing contemporary construction over Vail's dated inventory. Properties that do sell are sitting an average of 180 days and experiencing median price reductions of 12%. On a $5 million property, that's a $600,000 haircut. The town itself faces fiscal pressure. Sales tax revenue has declined significantly as visitor spending patterns shift. The municipal budget shows a $20 million shortfall. Census data indicates population decline for the first time in decades. Vail isn't collapsing, but it's experiencing an identity crisis. The cachet that justified premium pricing is eroding. For homeowners who've been in Vail for decades, this may represent market normalization rather than disaster. But for those who purchased in the last 3 to 5 years, particularly investors banking on continued appreciation, the current correction is financially painful. The lesson here isn't that Vail is doomed. It's that even the most established markets face cyclical pressure when economic fundamentals shift. Number 1. Aspen. We had to end here. Aspen isn't just a town, it's a global brand. For the ultra-wealthy, it became the ultimate status signal. The place where billionaires go to pretend they're ski bums, where private jets stack up like taxis. The pandemic created a buying frenzy, so detached from fundamental economics that the current correction is shaking luxury real estate markets worldwide. According to MLS data, the median sales price for single-family homes in Aspen has fallen 32% from peak. Homes valued at $40 million are now selling for $28 million. The paper wealth lost measures in the billions. More significantly, transaction volume has collapsed 65%. The ultra-high net worth buyers who drove the pandemic boom have moved on. Active listing inventory is up 210%. The market is flooded with sellers trying to exit simultaneously. Average days on market now exceeds 275 days. This isn't a functioning market. It's a standoff where sellers haven't yet accepted the new pricing reality. The ripple effects extend throughout the community. Luxury retail and art gallery sales are down 50%. Over 60% of all homes in Aspen sit vacant more than 10 months annually, according to Census Bureau data. The town has become a museum of empty second and third homes. But here's what our research emphasizes. The people experiencing the most acute pain aren't the billionaires negotiating $12 million price cuts. It's the year-round residents who watched their community transform into an exclusive club they could no longer afford to live in. Teachers, nurses, restaurant workers, the people who make a town function. Many were forced out years ago. The current market correction doesn't bring them back, because even crashed Aspen prices remain unattainable for median earners. The Aspen story isn't about wealthy people losing money. It's about what happens when a community loses its purpose. When the cost of everything becomes so detached from the value of anything that the social fabric disintegrates. The real estate market is simply reflecting that deeper dysfunction. Our journey through these 5 markets reveals a consistent pattern. These aren't stories of market failure. They're stories of market transformation driven by forces larger than any individual decision. The pandemic created a perfect storm of remote work, historically low interest rates, and urban flight. Investment capital flooded into mountain real estate, pricing out local economies. Now, with interest rates above 7%, insurance premiums soaring, and remote work mandates ending, that capital is retreating. The families who called these places home for generations are caught in an impossible position. Those who sold captured wealth, but lost community. Those who held on face property taxes based on peak valuations, while their neighbors' homes sit empty most of the year. New residents, even those with good intentions, entered at prices that make normal community participation difficult. There's no villain in this story. There are only choices, trade-offs, and consequences that rippled further than anyone anticipated. The regulations that crashed investor markets in Breckenridge were attempts to preserve housing. The insurance premiums crushing Telluride reflect actuarial reality about climate risk. The empty storefronts in Vail demonstrate what happens when pricing exceeds economic sustainability. For investors and prospective buyers, these 5 markets offer crucial lessons. Real estate isn't just about appreciation potential. It's about insurance availability, community economic health, local policy decisions, and whether the price you pay today reflects sustainable fundamentals or temporary euphoria. The mountain towns experiencing corrections aren't doomed. Many will stabilize and eventually recover, but the path forward requires market prices realigning with local economic realities. If this analysis provided valuable perspective, hit that like button. Subscribe to Housing Intel for weekly real estate intelligence that prioritizes data over hype. Drop a comment below. Which market story resonated most with you? And remember, the best real estate decisions come from understanding not just where prices are going, but why they got where they are in the first place. We'll see you in the next breakdown.